TheoTrade. This is Don Kaufman. April 27th, 2022, 30 minutes after the cash close here on this Wednesday afternoon. Facebook earnings are out. Market lifting ever so slightly, but really raising the question, can big tech save this marketplace? First and foremost, let's give you an update on kind of the internals of the marketplace. Really, I'm going to give you some opinion, little price action in here, what I see in the marketplace at the present time. Again, Facebook trading to the upside, kind of lifting the S&Ps a bit here in the after hours, lifting the Nasdaq. But again, it's fairly minor. What I want to start with this evening, it's not so much about kind of marquee levels in the S&Ps. I'm going to come back to that in just a moment. It's about issues that we face in terms of, you look at the marketplace and you think risk on, risk off. And if you're unfamiliar with that kind of terminology, risk on effectively means like, hey, buy everything in the S&Ps at, almost at any price. And risk off is when you start to, sell markets and buy, assets that would be thought of as like protection in the marketplace. And one of the issues that I'm having right now and you're facing in this marketplace is you see a lot of asset classes up higher that kind of tell you that, hey, this is risk off still. And that basically means, no, sell the S&Ps. And when I talk about like different asset classes, kind of referencing, and I'll start with is the dollar. This is not a warm and fuzzy move inside of the dollar. And with all due respect, if you're looking at any major currencies out there, we can talk about the yen until we're blue in the face. Why even discuss the yen? This is stuff that we typically don't bring to light here at TheoTrade. But if you're not looking at what's going on inside of the Japanese yen, you're missing a substantial picture. Or to look, for example, at something like the British pound, which is just getting annihilated. Or maybe we were to take a look at something like the euro US dollar, which is having one of the most devastating crashes that's been seen, again, anytime in recent history. And again, to kind of quantify that a little bit, pull up a 3-year chart. Do you realize that we're below some of the COVID lows out of the euro? But wait, I can actually pull up a max chart. You have to go back, okay, to periods that are, we're talking, 2003 to actually see the euro really kind of cracking through some of the present lows, which, again, we touched down here. But when did we touch down here? Briefly, the Brexit times. Again, these are massive, massive moves. And at the exact same time, you're like, okay, so how does this relate to risk on, risk off? It's dive into the US dollar at any cost because there's too much risk around the world. There's evidently a lot of risk inside of the S&P. I think that the alarming part on this front, and again, this is the piece I said, it's a little bit of opinion. When you start looking at the S&P 500, you're like, no, man, that S&P 500, it's getting pummeled. So you start pulling it on a 5-year time frame, start pulling the S&P on a 10-year time frame, and you go, whoa, okay, I kind of get what you're saying over here. You're seeing like once in a decade moves inside of some of the currency products. It's not just currency products. It's inside some of the bond product. Again, like once in a decade kind of movement in certain products. But the issue that I have is that the S&Ps, they haven't made that move yet. Okay, maybe this is the forefront of it, but it doesn't exactly leave you in a warm and fuzzy feeling. And again, I just wanted to kick off this evening's video, and I'm not trying to give you a bearish tilt, but at the exact same time, when you start to look at things like the US dollar, which is, everybody's talking about petrodollars, okay? They're talking about, currency in the US not necessarily being the reserve, for the entire world. Yeah, I'm not buying any of it. You start looking at a chart of the US dollar, it is effectively straight up. But I look at this from a vastly different perspective. I look at this as Uh-oh, they're getting out of every currency around. I mean, where are you going to go? You're going to go to the Chinese yuan? Of course not. You're not going to the euro. That's pretty evident by looking at the euro. Nobody's going into the Japanese yen. I mean, there's a currency crisis. To compound that, then you start looking at interest rates, and I'll bring up like the TNX. The TNX has exploded. Again, once in a decade kind of move over here. Would you think to yourself, and you step back from this, you're like, hey, that's going to break something. Okay, what's it going to break? The only thing that hasn't truly broken at this point has to be the S&P 500. Again, when you start looking at some, for instance, spiders, and you look on a year-to-date basis, all right, so they're down 12%. A little bit of damage inflicted. A little higher, than that, even the beginning of the year, but really that all-time high was right at the front of the year. We're off only about 12, 13%. The QQQ, okay, the Qs are not faring nearly as well. They're down almost 21%. People, there's room for improvement to the downside, especially when you start to compare, some what I would term risk on, kind of risk off assets, which actually brings to light, once again, the bond market. The bond market got a 2 or 3 day bid under it, but actually flipped over today. And this brings to light some bigger issues here. If these bonds continue to crater to the downside, I mean, it is just over in that marketplace. They're going to come after the Nasdaq and smack the Nasdaq again. This is not a pretty picture by any stretch of the imagination, because if you are buying bonds, if you're buying bonds right now, I assume that that's a duck and cover. That would be a big sell-off in the S&Ps and would actually cause traders to literally rush towards bonds, just like they're rushing towards the US dollar, right? So that's actually very problematic. But at the exact same time, if we start to sell in bonds and sell heavily in bonds, not just kind of meander down, but start to sell heavily in bonds, I think that's actually going to take the Nasdaq out at the knees. That higher interest rates are not going to be met with good graces inside of any of big tech companies. With that, I'll spin it around a little bit. I also want to take a quick glance at volatility. What's been changing in the volatility front? So pretty good explosion in volatility. The VIX is in the 30 handle. And when you start looking at the VIX, again, you can buy, 10 years, okay? There are very few instances of the VIX sustained above the 30 handle. And prior to the onset of COVID, you can count on one hand the number of times the VIX is even seen over the 30 level. Now, I don't look at the VIX as, it's a precursor, you should pay attention. Listen, the VIX is just simply telling you it's on right now. There's a lot of volatility, okay, and that's the end of the story. I wouldn't even bother looking at the VIX beyond that. What I do start to actually read into a little bit, though, is what we term contango and backwardation, and that deals with the volatility futures. And yes, I absolutely do pay attention to the volatility futures. We're looking at the May vol future versus the June volatility future, and again, the May volatility future is now above the June volatility future, putting us effectively in backwardation, which changes the nature of hedging activity altogether. When you actually see an inverted volatility skew, for the most part, when volatility starts to pick up, anybody that's actually caught short the May vol futures, they actually sell S&P futures to mitigate exposure. And it can actually cause markets to kind of spiral almost out of control to the downside. This is not a pleasant area for the marketplace right now. It's not a considerable backwardation, but unequivocally the vol futures are in backwardation. It's also worth mentioning the VVIX. The VVIX, okay, not exactly flying high. This is the volatility index, but even in today's kind of markets kind of cruise around a little bit. They're up maybe 32 handles right now. Even today, though, the VVIX didn't give up much, and that says a lot. Nobody's actually saying, no, there's no risk at all today. In fact, the risk actually grew as the day went on. Last but definitely not least, I do want to look at the S&P futures. And the reason I want to look at the S&P futures, okay, there's an absolutely pivotal level. And this is something I've mentioned just in numerous times. You look back on a 3-year chart, and I've got different levels. These are actually what we term gravity points. A very key gravity point happens to be, and again, I want to not only denote this, I want to script it on your screen so that everybody's aware of this particular level. It's 4211. Trade throughout all of last night was pretty much skirting around 4211. We did the 4211 thing all throughout the course of the day. We actually broke a little lower before the cash close, rallied back up. One of the things that I want to enunciate, make this crystal clear, moving into the 4211, moving higher, okay, from these lows into the 42.11, don't dare call that a rally. For the most part, when you're in the midst of some heavy volatility, what you get is like a marketplace that wants to migrate, okay, to key levels. At this point, that key level happens to be nothing more than 42.11. If we're going to make a break, a real break to the upside, you got to be above, for instance, 42.30. Anything above 42.30, you got me. You can call it a rally all you want, but it's one of the things that's very formidable in a marketplace like this. Now, what other levels do we have on the screen? I'll tell you exactly what levels we have on the screen. Take a look at the SPX, the mother of all products. So in the SPX, here we are on a Wednesday. So you got Thursday and Friday left, but net, you're looking at $134 expected move this week, and that means $134 higher or $134 lower. We came extraordinarily close to the $134 move to the downside. Now that downside is right around 41.40. That's inside of the SPX. Here's kind of a fun little note on that point. How important are these expected moves? And the answer to that is they're absolutely unequivocally critical. Just to show you how critical they are, last evening, when some big tech earnings obviously transpired, both Google and Microsoft came out roughly at the exact same time. Look at some of the lows inside of the S&P futures. Now remember, the S&P futures are the hedge for the SPX. So whenever you see an S&P future trade, I mean, it's pretty much one and the same as the SPX. The S&P futures are the underlying for the SPX. Look where they traded to, 41.37, 41.37. Here's the real irony. When you start looking at the SPX, okay, and again, this is literally going to zoom into it. That line across your screen happens to be none other than what? 41.37 on the button. The market is incredibly efficient at that particular point. So if you've got a rally on your hands, you know, you got to crack again above this like 42.30. You could break out to the upside here. However, at the exact same time, there's going to be some sell side activity. You have to look towards the lower edge of that expected move, and that's roughly that 41.40 kind of handle. Now, big tech earnings. As I said, yeah, all right. So Facebook came out. Facebook, though, has been getting annihilated lately. Now there's a bid back under it, and the bid takes us to 200. Now, if you look at this and you think to yourself, oh, it's an unprecedented move, really? So we closed roughly at what? 175. Where are we trading? 206. What's the expected move? $26 on the button, people. I mean, that thing is smack on what it's supposed to do. When it comes to tech earnings, I'm going to tell you right now, all you have left out there, okay, you've been through the Netflixes, you've been through the Googles, you've been through the Teslas, okay, you've got Apple coming up. Okay, it's big. It's something that could actually decimate the marketplace. What else do you have besides Apple? Well, of course, you've got none other than lovely Amazon as well, both of which are coming out tomorrow after the bell. Can tech earnings actually save the market? Absolutely not. They can create a short-term bid under the marketplace. But people, the point I want to make right now, there's a lot more going on than tech earnings. Okay, damage has been inflicted to the S&Ps. Damage has clearly been inflicted in a bear market inside of the Nasdaq. And at this point, it's not about tech. You got to keep your eye kind of on the prize over here. Better watch volatility futures very carefully. We're in backwardation. You watch things like the dollar. Okay, obviously the bond market. It's getting serious out there. It can get serious in a hurry. Understand, okay, that markets where we are right now, for instance, at 4,200, is it a pivotal area in here? You start opening up again, kind of a 3-year chart. You look down, you're like, wow, we are positioned, okay, in a horrible place. And why it's such a horrible positioning with big tech earnings coming out, okay, tomorrow, clearly that Facebook didn't even get us back to the 42.11. Maybe we migrate there overnight, but it's not even back there. But clearly with big tech, Amazon and Apple, okay, somebody misses over here, we're actually going to lose these lows. And one of the things that you're faced with is 4,100 will pierce right through it like it's nothing, okay? You're basically staring down the face of a cliff at this point inside of the S&Ps, and you have to be aware of that, okay? Because all of these risk metrics are through the roof. You look at the dollar, you look at the bond market, all right? Everything is pointing towards catastrophic risk. The tech earnings, if anything, I don't think they can save the market, but they can definitely punch a huge hole in it. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.